saw this in the news. There are 356,000 and some odd religious congregations in the United States. Almost 500,000.
That's a lot.
That's one for every 934 Americans. But the overall average congregational size is only about 451. I hear you talking about, I pulled this because I hear you're talking about, and forgive me if I'm saying it wrong, but charitable trust funds and how to save taxes with charity. And I thought, it's toward the end of the year. How do you have any ideas of give to people to wrap up the end of the year with charitable?
There's a big
giving?
push. There's a big push from the custodians like the Charles Schwab and Fidelity, TD Ameritrade, and all these big brokers to do donor advised funds. Have you heard of a donor advised fund?
If I have, it's only because you've mentioned it.
Okay, so a lot of them are doing donor funds. In fact, we just had a client a couple weeks ago come in that had a donor advised fund, and it was a good amount in there. And I was like, oh, so what's the purpose of that? Oh, we didn't have to pay tax on it. I'm like, yeah, but you just gave it away. It's not your money anymore. It's irrevocable. Like, it's gone. You don't get any benefit of it for your family anymore. I mean, I get it. You didn't pay any capital gains because they put part of their real estate into the donor advised fund, right, when they sold it. So the trust basically accepts the funds, and there's no transactional receipt.
Oh, okay.
So the IRS, you don't have to pay any tax on it.
That's nice.
Right. But there's no benefit for them. And I said, that was a good amount of money. You might have wanted to do something different, right? So, it's like if you put $1 million into a donor advised fund, they say they had $100,000 cost basis. There's $900,000 worth of gain.
Yep.
Right?
Yep.
Did you do that math? Let me repeat it for you.
It's pretty good. Yeah. That was
900,000.
10 minus 1 is 9. Got it.
Okay, good. All right. Well, I know you struggle with math a little bit. Anyway, so you've got the $1 million and you put it in the donor advised fund and you didn't pay any tax, right? But I said, why didn't you just do a charitable trust of some type? There's different kinds, right? I'm not going to go through all the list just on the show, but one of the most famous ones that everybody knows about is a charitable remainder unit trust, right? Or CRT for short, charitable remainder trust. And what that means is that it's a unit trust payout, meaning that it's got a percentage. So if you put $1 million in for this example, right? In the donor advised fund, they get no income for the rest of their life. The kids don't get anything. There's no benefit, right? They get a charitable deduction, which is nice. So they get a benefit this year, maybe even next year if it rolls over, depending if they use all the charitable deduction. It's really confusing, right? But the idea is if you have a charitable remainder trust, or you could do a pooled income fund trust, there's all kinds of different ones you could do. They can get income from that $1 million. Still didn't pay the capital gains tax, right? Because on that example, they probably would have paid almost $300,000 in capital gains.
Yeah.
So that's why they did the trust. They're like, hey, we don't need all this money anyways. Let's just put it in the trust. And it's going to go to Virginia Tech, right? Our alma mater. It's going to we're going to give it to the United Way. We're going to give it to our church or whatever the organization is. And they feel better about it, right?
Yeah.
The amount of assets they have, they don't need the money. But if you can benefit your family as well, because think about it, if you're able to take 5% a year in a unit trust, it's a unit trust payout. They're taking 5%. That's $50,000 a year for the rest of their lives. What if they live 30 years? And it grows over time. I mean, they took out.
That's legit.
$1.5 million, $2 million easily, and that's low amount, right?
Yeah.
Back in income that maybe they didn't even spend it all. Because we have clients taking out a trust. They're like, I don't even need it this year. Okay, well, just put it in the other account. Got a tax deduction on the money going in, right? No capital gains on that business sale, the real estate sale, or the stock sale, right? They bought Apple when it was cheap, or Amazon or something years ago, right? Yeah. And they held it and bought it.
Made a mint.
Right, and they're like, oh, but I don't want to sell it. Well, there's a way to sell it and essentially still get income from it, right? And that's what charitable planning is. We have a lot of folks that have become pretty wealthy over the last 10 years because of the run up in the real estate market, the run up in the stock market. Even though it's down this year, they're still up a lot. And they're going, Brian, do you think we're going to need all this? No, I don't need to even run the numbers, right? Because I'm looking at their expenses. They live well below their means. yeah, I don't think you're going to spend all this. So let's do some charitable gift planning because what's near and dear to your heart, right? I want to do this organization. I want to help out this organization. I want to help out this organization. I want to help out a church or whatever it may be. And so this is the time to do it. So charitable trusts are different than like IRAs. People get it confused. You have to do it before the end of the year. So the gift.
That's why I was asking the question.
Right.
Yeah.
Year end. That's why we're so busy right now, because we got people coming in and going, Brian, I got to get this done. I got to get this done. Right. And of course, they wait till December. That's just the way everything happens. Right. We're all procrastinators. And so it's human nature, right? We all wait to the last minute, but we're slammed trying to put all these pieces in there. And some of them are complicated, but the benefit of doing this situation, the charitable trust that we're talking about, not only are they not paying capital gains, they saved over 200 and some thousand, almost $300,000 in capital gains tax.
Mm-hmm.
But then there's also this thing called a charitable deduction that they get, which can help offset their tax this year, next year if they have too much and it rolls over. What we like to do with that is convert their IRA to Roth to absorb it all in the first year.
Yeah, yeah.
And that way, we got a short-term tax savings plan and a long-term all mixed in one. It's beautiful. Because,
and that Roth will grow and compound.
Yeah, and then when they're 72 and they got we just talked about them having $1 million in a charitable trust, they can take $50,000 a year. They got $50,000 of Social Security coming to them. They got the pension of $50,000. They only live on $100. How much do they need?
Yeah, right.
They're doing okay.
It's good salary.
They got enough
good annual income.
They got enough money coming in, right, after tax to live on. So the IRAs are not needed. So what are you doing when you got $2 million in an IRA and you turn 72? Oh, wait, honey, we have to take out $73,000. I don't understand. Why do we got to do that? Because you got to. And your tax bracket.
RMD thing.
Yeah. The RMD thingy.
Yeah. That thingy.
The thingy. And so you're sitting here going, okay, we got 76,000 there. Let's take out 21,000 of federal and state, and you get $55,000 left. They're like, what do you mean? How come? Where'd the other money go? I'm like, well, we'll send it 55,000 over because we had to pay the tax. But I don't want to take it out. Well, you have to. That's tax planning, right? There's a lot of moving parts there, but you're solving a short-term problem, selling real estate or the business, whatever it may be. You're eliminating the capital gains. And it's only for people. This is only for people. Now, here's the downfall, right? I just talked about all the pros.
Yeah.
The cons are at the very end of their life. You can stretch it out sometimes over their kids, especially we like doing it in a pooled income fund because you can stretch it out over the kids' lives. I mean, you got you got kids that are 30 years old, they'll get income for the rest of their life.
Nice, yeah.
And so it's an irrevocable trust. What happens is when it passes on to, when the kids pass, right, and then it goes to the charity eventually. Well, whatever's left in the trust goes to the charity. Well, that doesn't count towards the estate tax, right, because it's going to a charity. So some of our clients,
so you can't write that off, is what you're saying.
No, I'm saying you can if it's in the charitable trust. If it's not, it's included in part of your estate, and then your family would have to pay 40% if you're over the exemption.
Wow.
Now you got to have a lot of money to be over the exemption, but the families we're talking about on some of these situations are in that situation or are gonna be in that situation, right? They're 60 years old, they have a lot of wealth, or they're 55, and they have a ton of wealth and it's growing, and they're going to pay a lot of estate tax.
Yeah.
And so there's a lot of us. We just talked about eliminating 3 different types of tax: capital gains, Roth conversion, RMD tax, and estate tax. All in one estate plan, or all in one comprehensive tax plan that is really just eliminating hundreds of thousands of dollars in federal tax. But it's legal. It's legal. It's moral, ethical. Been around forever. Every tax attorney, estate planning attorney knows what it is. Now, a lot of them don't understand how they work. I mean, we had an estate planning attorney locally in Roanoke that I was explaining a charitable lead annuity trust, and he goes, "Yeah, I don't like those very much. Those are awful. It gives all the money away to the charity, and they never see it again." I'm like, "That's actually not how it works." But okay, before you say something is awful, you might want to
research it.
You might want to find out actually how it works. That's not. There's two different kinds of charitable lead trust. The one that we're talking about, after the 10 years, it comes back to the client or the trust or whoever owns it. Right? Yeah. And if the kids are alive, if they pass away, it goes to the kids. So they just got a set amount that was given out. So it's not a fit for everybody. This is the time of year because look, everybody is looking at ways to minimize their tax, and they're looking at year-end strategies that are legal. I'm not going to go to jail for it, right? Because everybody's look. I mean, most of the billionaires have charitable trusts. You look at they have charitable foundation is just another type of,
because they got people telling them what to do. They know what to do. They've got the Brian Bowens going.
Right, they have a financial planner. They
Yeah.
got a tax attorney. They got a CPA, and these guys are experts. And so, I mean, why did Hillary? When Hillary was running against was Trump, wasn't it?
Mm-hmm.
Yeah. So she put in $1 million or $1.25 million every year into her foundation. Well, the foundation is nice because she can actually take income, pay her kids through it.
Yeah.
And this huge tax benefit. Do you think she was doing it in the goodness of her heart?
Oh, yeah.
I'm sure. Yeah.
So I know that, it's year-end tax planning. I'm sure, and we're on in, a dozen different markets. When do people come? What's too late to come to you for the end of the year? Because, you celebrate Christmas and New Year's and everything else, too.
Well, yeah, it depends on the strategy. Some of the tax strategies are simple, it doesn't take a lot of time. It just depends on what the situation is, right? We got people that are coming to us late and they're saying, Brian, I sold this property, I sold this business, I sold this stock, and I didn't realize I could do something. I was listening to your show and you told me it's not too late, but I did it already. You're right. It's not too late. If you've done something foolish, as I like to say, earlier in the year on your own just whim desire, you sold a piece of property because you got an offer and you sold it and you're about to pay the tax. There's still things we can do. There's opportunity zones. That's one of them. We talked about opportunity zone funds. Mm-hmm. There's things you can do after the fact. In fact, there's things we can do next year even to affect 2022.
Sooner is better than later, though.
Yeah,
That's what I suspect. Yeah. Find us online at retirementplannow.com. That's retirementplannow.com.